Hello fellow entrepreneurs, welcome to my channel where I read and summarize books relating to being a better entrepreneur. I met no one who I thought was wise who didn't read. I believe reading is essential for those who seek to rise above the ordinary. So today, we will be learning from John Brooks' book, Business Adventures. So without further ado, let's get straight into it. You'll see why Bill Gates claimed that Business Adventures, which he received as a gift from Warren Buffett, was his favorite book of all time. These and other events described in his book represent several pivotal moments in American business history, the consequences of which can still be felt today. They paved the way for things like the prohibition of insider trading and the right of employees to work for whomever they want. This video is broken up into 12 parts. Part 1. Investors are irrational. Part 2. The Ford Edsel. Part 3. The state of the federal income tax system. Part 4. Insider trading. Part 5. Xerox. Part 6. Bailing out from the New York Stock Exchange. Part 7. The GE Wink. Part 8. Piggly Wiggly. Part 9. David Lilienthal. Part 10. Stockholders rarely use the power that is available to them. Part 11. Donald Wohlgeuth. Part 12. The Pound Sterling. Part 1. Investors are irrational. Investors are irrational and the stock market is unpredictable, as the 1962 flash crash demonstrated. If you were a stock market investor who fell into a 3-day coma on May 28, 1962, you would have woken to virtually no change in your investments, but you would also have slept through the chaos of the 1962 flash crash. This 3-day turbulence perfectly demonstrates how bizarre Wall Street bankers' behavior can be, and how investors are guided more by their mood than by actual facts. After 6 months of stock market decline, the mood on Wall Street was decidedly gloomy on May 28, 1962. That morning, there was a lot of trading going on, and the central office was behind in updating stock prices because it was done manually. Investors panicked when they discovered that they could only learn a stock's true price after a 45-minute delay, by which time they assumed the true price had fallen. As a result, they rushed to sell their stock, sending prices spiraling downward. Their expectations became self-fulfilling, resulting in a stock market crash that wiped out $20 billion in value. But just as emotions triggered the crash, they also aided the recovery. It was common knowledge among investors that the Dow Jones Index, which measured the value of the general stock market, could not fall below 500 points. As a result, when the value approached that limit, a buying panic erupted as everyone expected prices to rise. The market had fully recovered 3 days after the crash. Everyone was looking for rational explanations after this strange occurrence, but all stock exchange officials could come up with was that the government needed to pay more attention to the current business climate, or the financial market's mood and irrational expectations. The market's inherent irrationality is reflected in its unpredictability. In fact, to quote famous banker J.P. Morgan, the only thing that can be predicted about the market is that it will fluctuate. Part 2. The Ford Edsel. The Ford Edsel is the perfect example of a product launch gone wrong. Do you know what the Ford Edsel is? The car, which was supposed to be Ford's flagship product in the late 1950s, ended up being not only one of the most spectacular product failures of all time, but also one of the ugliest cars ever made. How could such a successful company as Ford fail so miserably? For starters, it completely misread the market. The American automobile market was booming in 1955. Families' disposable income was rising, and people were becoming more interested in mid-priced vehicles, a segment in which Ford was underperforming. That's when Ford began developing the Ford Edsel. Unfortunately, by the time the Edsel was introduced in 1958, the market had changed dramatically. A downturn in the economy and a shift in consumer preferences had caused people to flock to smaller, less expensive car models. Customers had unrealistic expectations for the car, which was the second reason for its failure. The Edsel had cost Ford $250 million to plan, making it the company's most expensive project to that point, a fact Ford emphasized in its marketing. This generated a lot of interest in the project, so when the Edsel was finally released, people expected it to be revolutionary. They were disappointed, however, to discover that the Edsel was just another four-wheeled vehicle. The Edsel's third and final flaw was its shoddy construction. Ford neglected to fine-tune the technical side of the car because it focused most of its efforts on psychological research to make the car appealing to its target group, which was young families with disposable income. As a result, once the product was released, customers discovered a number of flaws, ranging from unreliable brakes to jerky acceleration. Despite the fact that the Edsel wasn't completely useless in the end, it just couldn't live up to the hype. Part 3. The state of the federal income tax system. The federal income tax system should revert to the state it was in 1913. Despite the fact that Warren Buffett is one of the world's wealthiest people, he admits that his tax rate is lower than his secretary's. Doesn't that sound like a cruel joke? It's a perfect example of how unjust the federal income tax system is in the United States. Examine the system's increasingly twisted development since its inception to understand how it got so bad. The federal government began to levy an income tax in 1913, after decades of political debate and fears that it would be equated to socialism. The reason for this was that its own revenue stream had dried up, while its expenses had risen. Initially, income tax rates were low, and the wealthiest citizens were the primary contributors. Since then, rates have been steadily raised, and the tax has been extended to larger segments of the population, while more and more loopholes for the wealthy have been created. Income tax rates are generally quite high these days, and they disproportionately affect the middle class. Inefficiency is encouraged by the current tax structure. For example, freelancers will frequently stop taking on new contracts in the middle of the year in order to avoid earning more money because it makes more sense from a tax standpoint. Furthermore, enforcing taxation has become a battle due to the complicated system of loopholes. The Internal Revenue Service, which collects the tax, has to deal with an army of citizens as tax advisors and lawyers who specialize in evading the tax code on a year-to-year basis. On both sides, this is a massive waste of human resources. Tax reform, on the other hand, is politically impossible. Several presidents have attempted to simplify the tax code, but they have all failed. The current system simply favors too many wealthy people with too much power, and they refuse to give up their benefits, such as capital gains taxation being lower than salary income. Part 4. Insider Trading. After the Texas Gulf case in 1959, insider trading was finally outlawed. Imagine your uncle works for an oil company and calls you one day to tell you to buy his stock, because they've just discovered oil and won't be able to tell you until tomorrow. Isn't it possible that if you bought the stock, you'd end up serving time for insider trading? That is true today, but it was not always the case before the Texas Gulf case. In the wilds of Ontario, Canada, a mineral company called Texas Gulf Sulphur struck gold in 1959. Their preliminary test drilling revealed the presence of copper, silver, and other minerals worth hundreds of millions of dollars on the ground. People who were aware of the discovery chose to remain silent about it, while secretly purchasing Texas Gulf stock. As executives and other insiders began buying stock, they told their family members to do the same. When rumors began to circulate that the company had made a significant discovery, Texas Gulf held a press conference to actively dispel the rumors and spread misinformation, all while its own executives continued to buy stock. When the company finally announced its discovery, the stock price skyrocketed, making everyone who had purchased the company's stock extremely wealthy. Insider trading laws had never been properly enforced before, despite the fact that this behavior was unethical even by Wall Street standards. Texas Gulf was charged with deception and insider trading by the Securities and Exchange Commission, SEC, this time. Many investors were outraged by this unprecedentedly bold move. The court had to decide whether the test drilling results had clearly demonstrated the value of the find, and whether the company's subsequent pessimistic press releases were intentionally misleading. In the end, the court found the defendant guilty and stated that before company insiders can begin trading shares, the public must be given a reasonable opportunity to react to any news that will affect share prices. Insider trading has been regulated since then, and Wall Street has become a little cleaner as a result. Part 5. Xerox. The story of Xerox demonstrates how quickly success can be achieved and then vanish just as quickly. The automatic copy machine was a huge hit in the early 1960s, and the product's developer, Xerox, quickly rose to the top of the market. However, the company's fortunes plummeted in just a few years. Let's take a look at the 3 stages of Xerox's roller coaster ride. First, despite all odds, there was initial success. People used to be apprehensive about copying documents because it felt like they were stealing original content. Furthermore, the process was costly because the first copy machines only worked with specially treated paper. Nobody expected a high demand for Xerox's first plain paper photocopier when it was introduced in 1959. The company's founders even went so far as to advise their friends and family against investing. Despite this, the company's revenues had risen to $500 million in just 6 years. Second, there was a period of sustained success. Xerox was so confident in its abilities that it began to invest heavily in philanthropy. The owners wanted to thank those who had helped them and use their newly acquired position to influence society, as is typical of an overnight success. Xerox, for example, became the second largest donor to the University of Rochester, which helped develop photocopying technology in the first place. Furthermore, the owners appeared to be very concerned about the United Nations. They spent $4 million on a television campaign in 1964 to support the United Nations after it was attacked by right-wing politicians. And lastly, Xerox was forced to see how quickly success can turn into defeat in the third stage. Xerox realized it was in trouble shortly after reaching its pinnacle of glory in 1965. its technological advantage over competitors had eroded as they began to produce cheaper knockoffs. Furthermore, new research and development investments were ineffective, leaving the company stranded. These 3 stages are a good example of the various stages that a growing company can go through. Fortunately for Xerox, it made it through the 3rd stage and is still going strong today. Part 6. Bailing out from the New York Stock Exchange. In order to avoid a financial crisis, the New York Stock Exchange rescued a brokerage in 1963. Ira Hoppt & Co., a brokerage firm, was in financial trouble in late 1963. Its membership in the New York Stock Exchange, NYSE, had to be revoked because it no longer had sufficient capital to trade. The reason for this predicament was that the commodities brokerage had made a bad deal. It had purchased cottonseed and soybean oil for delivery at a later date and used the warehouse receipts as collateral for a bank loan. Unfortunately, it turned out that the receipts had been falsified and that the oil had never existed. Ira Hoppt & Co. became the victim of large-scale commercial fraud and was unable to repay the huge debt. Ira Hoppt & Co. needed $22.5 million to become solvent again after meeting with several banks, shareholders, and the NYSE. To make matters worse, the entire country was in shock. President John F. Kennedy had just been assassinated, and the stock market was plummeting. Instead of allowing Ira Hoppt & Co. to go bankrupt, the NYSE took an unprecedented step and saved the brokerage. The NYSE was concerned that the bankruptcy of Ira Hoppt & Co., which occurred during a period of national panic, would cause people to lose faith in their investments and cause Wall Street to crash. They believed that the brokerage's survival was critical to the country's well-being, so they collaborated with the NYSE member firms and the brokerage's creditors to devise a plan for Ira Hoppt & Co. to repay its debts. The New York Stock Exchange pledged $7.5 million, which is nearly a third of its total reserves. It was able to save Ira Hoppt with the help of other lenders. The NYSE is unlikely to make such a bold move again, but it saved the country from a financial crisis during a time of national panic. Part 7. The GE Wink. Communication errors can be blamed by executives for immoral or criminal behavior. When a company is embroiled in a scandal these days, it will claim that no one did anything wrong and that the real problem is communication problems. If a company dumps toxic waste into an aquifer, for example, it isn't because of greed, but because the board failed to properly communicate the new environmental strategy to the local managers. In the late 1950s, when General Electric, GE, engaged in a large-scale price fixing, this claim was put to the test. A total of 29 electronics companies conspired to fix the prices of $1.75 billion in machinery, with over $500 million coming from government agencies. The customer may be charged up to 25% more than the normal price for the repair. The scandal was brought before the court and a Senate subcommittee when it was revealed that GE was the ringleader of the price fixers. Despite the fact that some managers were fined and sentenced to prison, no higher-ranking executives were charged. What's to stop you? They claimed it was all due to a communication breakdown in which middle managers misunderstood their orders. There were 2 types of policies accepted at GE at the time, according to reports: official and implied policies. It was an official policy you should follow if executives gave you an order with a straight face. If they winked at you as they gave you an order, however, it was up to you to interpret it. You were usually supposed to do the polar opposite of what the executive said, but there were times when you had to guess what the executive was getting at. You'd be the one in trouble if you didn't figure out what was implied. As a result, many managers assumed that GE's policy prohibiting discussing prices with competitors was just a window dressing. However, once they were in court for price fixing, they realized they couldn't hold the executives responsible. This story demonstrates how executives can use communication issues to avoid taking responsibility for a variety of illegal activities. Part 8. Piggly Wiggly. Piggly Wiggly, the world's first self-service supermarket, was nearly destroyed in a stock market battle by its owner. You've probably never heard of Piggly Wiggly unless you live in the southern or midwestern United States. In any case, it patented the self-service supermarket concept in 1917. It was the first supermarket to provide shoppers with shopping carts, price tags on all the items, and checkout stands, among other things. Piggly Wiggly is still in business today, but its eccentric owner, Clarence Saunders, who went to great lengths to combat financial speculation, has made it relatively unknown. Piggly Wiggly was rapidly expanding across the United States in the 1920s. When a couple of Piggly Wiggly franchises in New York failed in 1923, some investors tried to take advantage of the situation by launching a bear raid against the company. A bear raid is a strategy in which investors make investments that only profit if the stock price of the company falls, and then do everything they can to force the stock price down. Piggly Wiggly claimed that the failed New York franchises had put the entire company in jeopardy. Saunders was enraged and decided to teach Wall Street a lesson by attempting to corner Piggly Wiggly's stock, which meant buying back the vast majority of it, and he came close to succeeding. He announced publicly that he would buy all existing Piggly Wiggly stock, and after taking out a large loan, he was able to buy back 98% of the stock. This caused the stock price to rise from $39 to $124 per share, which was disastrous for the bear raiders, who suffered massive losses as the price rose. The raiders, on the other hand, were able to persuade the stock exchange to grant them a payment extension. Saunders' position was untenable due to his debts, and he was forced to declare bankruptcy as a result of his losses. You might be wiggling your way through the aisles of a Piggly Wiggly instead of shopping at a big box store like Walmart if Saunders had more influence over the stock exchange. Part 9. David Lilienthal. David Lilienthal's example demonstrates that business acumen and a clean conscience can coexist. Many people will accuse a highly influential government bureaucrat of being a sellout if he enters the business world and uses his old government connections to make money. This would not be an appropriate accusation in the case of David Lilienthal. In the 1930s, Lilienthal worked as a good civil servant for the President Franklin D. Roosevelt, who was a reformer. In 1941, he was named chairman of the Tennessee Valley Authority, which was charged with developing and distributing low-cost hydroelectric power in areas where private providers were unavailable. Later in 1947, he became the first chairman of the Atomic Energy Commission, emphasizing the importance of nuclear power's peaceful civilian applications. And when he finally retired from public service, he was forthright about his motivation for the move in 1950, stating that he wanted to earn more money so that he could provide for his family and save for his own retirement. Lilienthal proved to be a dedicated businessman once he entered the private sector. His background in energy qualified him for the mineral industry, and he took over the severely ailing Minerals and Chemical Corporation of America because he wanted to experience the trials of entrepreneurship. He was successful in bringing the company back from the brink of bankruptcy, and as a result, he made a small fortune. His new line of work also influenced his own views. He penned a divisive book about the importance of big business to the U.S. economy and security. His former government colleagues accused him of betraying them, but Lilienthal was simply passionate about both sides of the issue. After deciding that he wanted the best of both worlds, Lilienthal founded the Development and Resources Corporation in 1955, a consulting firm that assisted developing countries with major public works projects. This latest venture demonstrates that Lilienthal is the ideal businessman. He is responsible to both shareholders and humanity in equal measure. Part 10. Stockholders rarely use the power that is available to them. Who do you believe are America's most powerful people? The stockholders, in theory, should be it. Many political scientists have suggested that the United States resembles an oligarchic feudal system rather than a democracy because they own the largest corporations in America, and these giant corporations wield such great power in American society. The board of directors of these major corporations is always elected by the shareholders, giving the shareholders true power. Shareholders gather once a year for an annual meeting to elect the board of directors, vote on policies, and question the company's executives. But, far from being the solemn occasions you might expect, these gatherings are usually completely absurd. Because the company's management does not believe the shareholders are their bosses, this is the case. By holding meetings far away from the company's headquarters, they make it difficult for shareholders to attend. They try to keep the shareholders from getting involved at the meetings by droning on about the company's stellar performance and prospects. Most shareholders respond well to this strategy. Professional investors who challenge the company board and management to a debate are the only thing that makes these meetings interesting. At AT&T's annual shareholders meeting in 1965, investor Wilma Sauce chastised chairman of the board Frederick Kappel and even suggested he see a psychiatrist. Sauce is a professional investor who owns stock in a number of companies and wants to hold them accountable for their actions. Sauce was fighting for more women on the board of directors in this case. Trying to rouse apathetic investors, on the other hand, is a thankless task. Nothing is more passive and compliant than a small investor who is regularly fed dividends. Company management would not be able to do whatever they wanted if shareholders exercised their power more frequently. Part 11. Donald Wohlgeuth. Even if you have access to trade secrets, you can change employers thanks to Donald Wohlgeuth. Would you be able to accept a highly tempting job offer from a competitor of your current employer if it came your way? Actually, your right to do so wasn't always so clear, and you can thank Donald Wohlgeuth, a research scientist, for setting the precedent that allows you to do whatever you want. Wohlgeuth was the head of the B.F. Goodrich Company's spacesuit engineering department in 1962. During the race to the moon, the market for space-related products was booming, and Goodrich was a market leader in spacesuits. However, at the time, the company had just lost a contract for the now famous Apollo project to International Latex, its main competitor. So Wohlgeuth jumped at the chance to work on the prestigious Apollo project for International Latex, where he would have more responsibility and a higher salary. When Wohlgeuth informed his superiors at B.F. Goodrich of his departure, they were concerned that he would reveal the secrets he had learned about spacesuit production. B.F. Goodrich sued Wohlgeuth as a result of this fear and the fact that Wohlgeuth had originally signed a confidentiality agreement. When the contentious case went to court, two key questions arose that were almost philosophical in nature. Can action be taken against someone based on the assumption that they will break an agreement, even if they haven't done so before? Should a person be barred from working in a job that might tempt them to commit a crime? In a landmark decision, the judge ruled that, while Wohlgeuth was clearly in a position to harm Goodrich by disclosing what he knew, he could not be found guilty of it in advance, and thus was free to work for International Latex. This decision set a precedent for similar decisions, making it a huge win for workers' rights. Part 12. The Pound Sterling. Speculators attacked the pound sterling in 1964, and even a coalition of central bankers was unable to defend it. Because of its age and high value, the British pound sterling was perhaps one of the most prestigious currencies in the world in the 1960s. As a result, when the pound was attacked by financial speculators in 1964, central bankers all over the world felt compelled to defend it. The attack's origins can be traced back to the 1944 Bretton Woods Conference, when the world's major economies agreed to create an international monetary exchange system in which all currencies could be exchanged at fixed rates. This meant that governments had to frequently intervene in the currency exchange market by buying or selling currencies in order to maintain these fixed rates. In 1964, the United Kingdom was facing economic difficulties as it had a large trade deficit. Currency speculators predicted that Britain would be forced to devalue the pound if it could not maintain fixed exchange rates. As a result, they began betting against the pound in the market, hoping for it to lose value. A broad coalition of monetary policymakers led by the U.S. Federal Reserve mounted a defense against the threat posed not only to the prestigious pound sterling, but also to the international monetary exchange system itself. To combat the pressure to devalue the currency, they began to buy pounds. The strategy appeared to be working at first, as the first waves of attacks were repelled. The speculators, on the other hand, were tenacious, continuing their attack for years. Finally, in 1967, the alliance could no longer afford to buy more pounds, forcing Britain to devalue the currency by more than 14%. In retrospect, the dispute over the value of the pound sterling was merely the first sign of the Bretton Woods system's inherent flaws, which would be resolved just 4 years later in 1971. A skeptic might wonder how an out-of-print collection of 1960s New Yorker articles could have anything to do with business today. When Brooks profiled Xerox in 1966, the company's top-of-the-line copier weighed 650 pounds, cost $27,500, required a full-time operator, and came with a fire extinguisher due to its proclivity for overheating. Since then, a lot has changed. Many aspects of business have changed, and this is undoubtedly true. The fundamentals, on the other hand, have not changed. Brooks's deeper business insights are still as relevant today as they were then. In terms of longevity, Warren compares business adventures to Benjamin Graham's The Intelligent Investor, a 1949 book that he considers to be the best book on investing he has ever read. This wraps up the summary from the book, Business Adventures by John Brooks. Thank you for sticking out through the very end of this video. Nothing helps out my channel more than y'all watching the entire video. These videos take a long time to make, and is a labor of love. If you'd like to contribute by buying me a cup of coffee, I'll leave the link below along with a link to this book. And as always, if you liked this video, please like and subscribe, and watch these videos that might pique your interest. I'll see you on the next one. Until then, keep reading.